Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the record run for stocks as the bull market sees major inflows. We will break down these new numbers and debate what it means for the rally. Joining me for the hour, Josh Brown, Shannon Sakosha, Jim Leventhal, Brian Belsky. We'll check the markets. We are in the green across the board, extending those record highs for the Dow Jones Industrial Average, S&P 5729. We're watching that here, good for about 0.25%. NASDAQ's good for about a half. So, Josh, confidence was a miss, biggest decline since August of 21. Markets shrugged that off a bit, and as I said, it feels like investors are buying into this "don't fight the Fed" notion because, as I mentioned here, equity client flows from Bank of America, the third largest equity inflows in the history of their data last week. Net buyers of U.S. equities, almost $7 billion. That's the biggest since October of 2022. Is that what we should be doing, buying into this bull market here?
Look, I think the reasons for the buying are fairly obvious. We are now into the Fed loosening cycle, and the tightening cycle hasn't caused anything to blow up. And this was one of the, when you talk to people that were sitting in money market funds, and by the way, money market funds had a total of $6.3 trillion, which is a huge amount of money, both in absolute terms and relative to the overall investment markets. When you talk to people who are sitting with 30, 40, 50% of their assets getting 5% risk-free, 5.5%, close to 5.5%, one of the number one things they said was, I'm happy with my 5%. I'm not taking any risk. I don't have to worry about volatility. I don't have to worry about the Fed and blah, blah, blah. Now the Fed is cutting. We haven't had the recession that was prophesied. And we haven't had any sort of major event, an exogenous event that has come to blow up the market. So now what happens? You're up 19% year to date on the S&P. We don't have one of those massive issues, at least not at the current moment. And now that overnight rate is coming down. Look how fast the 2-year moved. So now people are saying, well, wait a minute. 5% was awesome. 4.5% is pretty good. 4% is not going to feel great. And 3 points is where the betting markets are is going to feel terrible, especially if the markets remain healthy and earnings are going to grow. So I do think there's going to be a lot of reallocation. And I think the flows that you saw this week, Scott, are directly attributed to this idea of people positioning ahead of that.
Are they directly attributed, Brian, for one of the reasons why you raised your S&P target to 6,100 last week, the highest on Wall Street, assuming that Fed's cutting, money's going to come out of cash equivalents, money markets, and whatever else and go into equities and help for that push?
Yeah, thanks for having me, by the way. I think the big thing is we're really looking at a major reallocation out of cash and fixed income, by the way, into equities. A lot of people, as Josh said, have missed this, especially a lot of institutions, but a lot of our private wealth clients have been participating into this. We wrote the note before the Fed cut, and then we wanted to see what the Fed was talking about after a cut. It was a moot point for us whether or not it was going to be 25 or 50. But at the end of the day, Josh is right. The trend is your friend in terms of the direction of the Fed. This is a tailwind for stocks, and we still think there's a lot of participation beginning to expand, which is a very, very strong notion for a bull market.
I mean, you're assuming, I think, many are, that this mountain of cash that's been sitting over there is going to come into equities. Rick Reeder, BlackRock, yesterday, closing bell. Listen to what he told me about all this money on the sideline. He likes stocks. He said as much multiple times, but he might like something a little better. Listen.
Boy, there's a lot of cash, and with the Fed putting foam on the runway, with the Fed bringing the rate down, could both equities and debt do well? I think so. My only point is, would you move the needle going into an election, geopolitical risk? Would you move the needle a little bit, downshift the risk, take some yield? That's the direction of travel, I think.
Now, Shan, there are those who might say, well, of course he's going to say that. He's the CIO of fixed income at the world's largest asset manager. But Rick's not like that. He's nuanced. I mean, he knows, he says when he likes stocks a lot, stocks are going to go up. He'll tell you straight out. But given the risks that he cites, geopolitical, you got an election coming up, do you actually get a better bang for your buck? Is it better for risk to actually go into credit here with the cash that Brian talks about, Josh talks about, and so many others cite?
Well, I think there's a perception that all of the cash came out of equities in the first place. And so now when you're thinking about what the potential is, you're looking at two factors. Number one, where do you think you're going to want to have your money at the beginning of 2025? And so that's your eventual goal as you look to position for next year in an environment where the economy maybe is not slowing quite as fast as some had feared, but more importantly, there's an accommodative Fed backstop at this point. Second, if you were in cash that came from fixed income, I agree with you, Scott. I think that there is some desire to potentially add some credit exposure. And it's not necessary to go out too far on the curve. If you just think about sort of the short to intermediate part of the curve, out of cash, moving up along the curve, you could hang out there for a little while as you wait to see what happens with the election. But I do think that there was enough of this cash, and we talked about this for a long time, that could potentially fuel not only just a broader move to equities, but also a move to equities that are outside of the areas where people have been concentrated. So there's this dual concentration, this barbell of cash and mega cap tech, and there's a lot of opportunities to either take more credit risk, more duration risk, or equity risk outside of those areas where you have this barbell.
Jimmy, I mean, his point, Reader's point, is, yeah, I like stocks a lot, but a lot's already priced in. Valuations are rich because stocks have run a lot. Expectations for earnings are pretty high going forward, maybe too high, and therefore it doesn't justify the multiple to where stocks have run. We already know the cuts are in the market at this point.
I mean, look, his analysis is spot on. However, I believe, Scott, that the market is going to go higher. I think Brian's actually right on 6,100. Now, the analysis is going to say, well, wait a second, that's 22 times next year's earnings. That's too much. How could that possibly be? You're perfectly legitimate to have that opinion, but here's what's going to happen, because it happens every time when you have a year like the one that we're in, where you're up big going into the fourth quarter. You know what happens? Professional money managers, some of whom have sat on the sidelines to a certain degree, they didn't believe it. Let's face it, there were plenty of times this year that people thought a recession was imminent, and some people reflected that in their portfolios. They will be forced, it happens every time you have a year like this, they will be forced to chase the rally. It will happen, and we can discuss whether Brian's right or wrong and whether 22 times next year's earnings is right or wrong, but what I just described is highly likely to happen.
But maybe volatility that some expect to happen between now and the end of the year chases some people away from actually chasing the rally. And by the way, in an email back and forth this morning, Rick Reader says the following: I think real rates are super attractive, especially relative to where beta is priced. I think equities will do okay given the cash out there, the broader point that's been made here. I just think they're far from cheap or valuation supported at these levels.
And I think to the extent, first off, he's right. Real rates are attractive. In terms of where they've been for the last 20, 15 years on bonds, they are. However, if you're concerned that maybe 22 times next year's earnings is a little lofty, look at other areas of the markets. Now, this is a discussion that we've been having for quite some time. I will be the first to admit a lot of fits and starts in terms of, are small caps for real? Is the equal weight S&P 500 where you should be? What about cyclicals? And the answer to the question is, if you're scared off, it's legitimate, about 22 times next year's earnings, look at sectors like financials, industrials, energy, materials, which not only have attractive multiples, they have good yields, and just maybe, and I'm not going to put a lot in this, but maybe the China news.
Okay. Go finish.
Yeah,
maybe the China
news is for real.
I like where you're going with that, because a lot of those areas of the market are moving higher today on the news out of China.
Yeah.
That, you know, the central bank's going to stimulate the economy there as much as they have to, as if anybody ever doubted that. But nonetheless, it's the industrials, materials, those stocks are hitting record intraday highs today.
Yeah, and look, what they're not doing, which they need to do, and I'm not being provocative here, is knocking down all those empty buildings and rebuilding them. I'm not being provocative. That's what you really need to do if you want to recover the steel market, the energy market, the concrete market, all that sort of thing. However, they are taking an important step in that direction. We're seeing it reflected in commodity and other cyclical stocks today. You know, is this a little bit of a sugar rush? Perhaps, but they're moving in the right direction. That's what the market and the valuations of those highly cyclical stocks are demanding. They're getting it.
It just shows you, Josh, how starved people are for this China comeback. K-Web leaders today, by the way, you picked it as your contrarian play this year. 10 cents up 15%. JD.com's up 10. PDD Holdings is up 10. Alibaba's a new 52-week high today as well.
Yeah, the Hang Seng and the Shanghai Composite both gapped up 4%. The news hit 9 a.m. So both of the major stock markets in China gapped higher, and the K-Web is up like 9% as we speak. I want to double click on what you just said because I think it's the most important part of the news. It's not just China's central bank. This is in conjunction with the State Administration for Financial Regulation. So this is the equivalent to what happened during COVID when the Treasury and the Fed got together and jointly announced how we were going to deal with this holistically across the whole economy and the markets. My friend Brendan Ahern at Crane Shares, who watches this space closer than anyone, said the policy bazooka has been unleashed. You guys should probably book him for Closing Bell today. Here's the bottom line. This is not just lower interest rates. They are directing mortgage rates lower to where they want them. They are deliberately talking about supporting private equity. They want to bring about mergers and acquisitions. This is Chinese regulators saying more mergers and acquisitions. You know what they looked at? They looked at the success of Japan. The Japanese stock market head directed all of the listed companies on the Nikkei to come up with a plan within 1 year of how they're going to increase shareholder value. If your stock is selling below book value, tell us in print what you're going to do about it, and we're going to put it on our website. And there was a study that looked at what happened to the Japanese companies that were the soonest to market with their plan to increase the valuation of their own stock. Those stocks absolutely went berserk to the upside. The Chinese are not immune to that zeitgeist. They see it happening in Japan, and they say, well, why is our stock market the worst large stock market in the world? The reason this is important for U.S. investors is because regardless of the political reality, China is still the most important economic engine in the world. More important to Europe than to us, fine, but this stuff matters. It matters to our cyclical companies. It matters to our entertainment companies. It matters for consumer staples companies. So I genuinely think that we should be emphasizing the fact that China wants to get serious about promoting capital markets, and I don't think it should just get lost in the shuffle. It's a very big deal.
Belsky, Freeport, leading the S&P 500 today. To our point about materials and industrial type stocks, Caterpillar, a new record intraday high as well.
Now remember, when you take a look at the Chinese economy and how it's worked, they're still trying to learn how to be consumers. And that's why the industrial side has been so important there the last several years with the industrial stocks and material stocks at Freeport being a leading indicator on the copper side. We've owned the stock for years and years, and that's going to really, I think, foretell what's going to happen with the overall global economy. So I think it's very, very good news.
Yeah, I mean, I think the other thing is, they're learning how to be consumers, and the Chinese government is also learning how to support consumers, right? It's always been very much been business-led, enterprise-led, a lot of the stimulus that the Chinese government has put into place. And so if you look at what's going to happen over the course of the next year, is this going to create immediate consumer confidence? Probably not.
No.
But is it reflective of perhaps a policy shift that absolutely needs to happen, because the industrial side of the equation is not the only thing that needs to be bailed out at this point in China.
You may still have the issues that have kept people out of investing in Chinese-related stocks, just not feeling all that comfortable about your investment, right? We've had multiple people come on over the last couple of years and suggest it's uninvestable. It's been painted here as a game changer today for thinking about investing in China-related companies. Is that how you're thinking about it? Should we be thinking about it?
Let me be clear.
It's not like those other issues don't exist anymore.
Yeah, it's a good question. I just want to be clear. I'm not going to invest in Chinese stocks. I am going to invest and am invested in U.S. stocks that have meaningful Chinese exposure or are driven by Chinese demand. I still think there is the question of the unknown in terms of how the government regulates Chinese stocks. Josh, I heard what you said. But I also want to make this point, which is important as we talk about teaching the Chinese consumer to consume. There is a next step that the Chinese government can take, which is to really establish social safety nets that we take for granted here in the U.S. to a large degree compared to China, where they don't exist. And because they don't exist in China, the Chinese consumer is relying on themselves to get them through old age and any medical maladies. that really holds back their ability to consume, their willingness to consume. Now, this is an obvious next step, except for one issue, which President Xi thinks that any entitlement spending is going to make his people lazy. Does that change? I have no idea. I'm not in a position, and I don't think anybody is, to say that it will change, but it could change. And if added to what we're seeing today, that would be monumental. That would be monumental.
So in terms of what people are talking about, in terms of the sectors that they like or dislike in the current environment, Brian Belsky, come to you first.
Yeah.
Wells Fargo Investment Institute has a note telling people straight up what to buy on dips and sell on rips. All right, favorable. Comm services, energy, industrials, financials, materials. Favorable. What do you think?
I think it might be too early on energy, just because, from a growth perspective, these stocks are still in trouble. And I think from a WTI side of things, the trend is not in its favor. We own the big integrateds like Exxon and Chevron, and we think they're fine because of the dividends. But if you're thinking about seeing more broadly distributed performance within the energy sector with the drillers and the refiners, I still think that there's a lot of problem there. So from a RIP side of things, we love communication services just because of where their growth is, and plus you can also have a barbell between Google and Netflix on one side and AT&T and Verizon on the other. I think that's really the one you should focus on.
Unfavorable. Discretionary, staples, real estate, utilities.
Don't agree with the discretionary side of things. Discretionary, it's one of the coolest things that people don't talk about. Consumer discretionary actually always outperforms. If the economy thinks it's going into recession or GDP begins to slow, consumer discretionary outperforms, period. And I think that's why we've seen so much volatility in the discretionary sector, because we don't know how to pick stocks anymore. Staples, I think, are expensive. The utility side, we're completely on board. We like the REIT side more than we do the utility side with respect to playing rates right here.
Why is it period? Why do you put a period there if you have the biggest decline in consumer confidence since August of 2020?
That's when you want to buy them. That's when you want to buy discretionary into declining confidence, because it provides opportunity. When people are getting fat and happy on the sentiment and consumer confidence, right, that's when you want to peel out of it and look more contrarian. It's a complete contrarian trade. It always works that way. Think about Amazon. Think about Amazon in the consumer discretionary space in March of 2020. It was like a godsend. That's when you wanted to jump in. When the world's coming.
If you're you can't make Amazon the litmus test of the discretionary stocks, because that's unfair.
No, but look at
take Tesla and Amazon out.
Okay, take Tesla and Amazon out. Look at what Home Depot did. Look what Target, Walmart, Costco are technically consumer staple stocks, but they're really the litmus test for the U.S. consumer right now. And so look at Costco's at 56 times earnings and continues to climb. I mean, people are being very, very smart with respect to how they're spending the discretionary money. So we would disagree that consumer discretionary is an area you need to get out of. You need to be excessively more selective in terms of the names that you're looking at.
Speaking of Teslas of the world and the energy debate as to whether it's too early or not, Bill Baruch, he joins us now because he, of course, a member of our investment committee, is making moves. He's the founder of Blue Line Capital. He joins us on the phone. Thanks for calling in. So let's go through these. You trimmed Tesla, which is now positive on the year. You trimmed it by about a quarter of your position. Why?
Yeah, so now we've ebbed and flowed with Tesla pretty well this year. We added to it at the last week of August. We talked about it on the show. And going into this robotaxi event, October 10th, we felt like we were going to see this thing rally up. The sentiment has been pretty poor around it. We're starting to see that turn. And the thing that I like here is about trimming it is we're back up at 250. There's a lot of resistance, 250 to 260. It's gotten too big within our portfolio. Trimming it back a little. Now we're going to be back to number 10 or so. They almost got in the top 5.
All right. So you want to have a debate about energy here as well because of the moves that you made here. You bought more Exxon. You bought more Kinder. You sold SLB, taking a loss there, but Belsky just made the argument that energy is not going to work right now. You bought more Exxon and Kinder, as I said. Why?
Well, first, SLB was really a tax harvesting loss to that Tesla profit trade. And what we're doing is reallocating these monies to energy. And we're actually 13% weighted at energy right now. Inventories have been very, very tight. And in fact, from a positioning standpoint, managed money and crude oil futures has hit net short over about a week or so ago. And diesel over the last week, the negativity around it, once it gets here, it usually can bring a bit of a bottom. We like to see this China news happened overnight tonight after we made the move. And so we do like seeing that tailwind. Exxon is really cheap. We owned Pioneer Natural Resources before this acquisition. and we really like the synergies there. I think Exxon has really outperformed within the space, and as a fully integrated, I know, Brian, you mentioned the dividend there is terrific. Tender, I really like, everybody's talking about AI, but how are you, power is going to be a big thing with AI. We really believe in natural gas and the movement, logistically getting natural gas in order to generate power. Tender Morgan is going to be right in the thick of that. I think ultimately we're going to see Tender Morgan implement AI for its own usage and pipeline, but it's going to help supply power. And I think that it's actually breaking out right now from a bullish pennant. It looks terrific on a chart.
All right, we're looking at the chart. We'll follow it. Bill, thanks. We'll see you soon back here on the desk. I look forward to that. Bill Baruch, Blue Line. All right, Jimmy, you got some moves too before we take our first break. You are doubling down, it seems, on Adobe, right? You bought more in the last couple of days.
Right.
Including today?
Including today and yesterday. And look, I think it's found bottom here. That's, debatable. The quarter that was reported a few weeks ago wasn't as bad as everybody seems to be making it out. I think most people who analyze the stock realize there were some orders that were pulled forward into the prior quarter. There were some orders that are reasonably expected to be filled in the first quarter of 2025. Trading at a 26 times forward multiple for a stock that, in my opinion, has done a good job of monetizing AI, one of the earliest companies to do so. I'm willing to step into this with a little bit more capital. At the same time, Scott, I'm trimming Visa. I woke up this morning and I was tempted to sell it outright, but I decided just to trim it. It's been a good performer over the 5 years that I've owned it. But this antitrust news, and I know there's a long way between when the DOJ files a lawsuit and when it's resolved. I know that, but it's just not something I want to wake up every morning thinking about what in kind of my heart I know, which is there is a monopolistic issue with Visa. And I don't know that the DOJ is going to prevail or not, but there's an issue there that I just don't want to have to deal with every morning when I see the news feed.
You literally sold the stock, or you trimmed it on the headline this morning?
I literally trimmed it on the headline, combined with the fact that it's at a forward multiple. It's at the upper end of its long-term channel. Again, it's done well for me. It's just not the news I want to be digesting every morning and discussing with you. Now, by the way, I still have a position. I know you know me. If I have a position, doesn't matter how big it is. If there's bad news, you're coming at me. I'll be ready to field anything you hit me.
After the preamble home.
We own it. This has been going on for 3 years.
I know, barf.
Exactly.
Go ahead.
No, I mean, this investigation has been going on for 3 years. How long, much more is going to go on? I mean, we still think it's one of the leaders in the payment system, so we're going to own it. I like these types of investments when the market's down.
Look, I think the important thing here is whether you're right on 6,100 or not, this is more than ever a stock picker's market. All right,
Yep.
This is not a market. Let me rephrase this. This is a market that's up 20% year to date. Pick your stocks carefully. That's what I'm trying to do.
All right. Straight ahead, we will talk about the one e-commerce giant that is beating most of the Mag 7 this year. I'm not talking about Amazon. We will tell you what it is. Kate Rooney will next. All right, welcome back. It's an e-commerce giant whose stock has been on a tear this year. No, we're not talking about Amazon, but a company often compared to it. CNBC's Kate Rooney joins us now with more. What are we talking about?
Hey, Scott. So it's not Amazon, it's Mercadolibre we're talking about. This is the Argentinian e-commerce giant. Some call it the Amazon of South America. It's been outperforming mega cap tech lately. It's up about 64% in a year. Compare that to roughly 50% for Amazon, 30% or so for the S&P. Wall Street has been overwhelmingly bullish on this name lately. Roughly 90% of analysts out there have a buy rating. Margin expansion has been a big driver of some of that optimism. Brad Gerstner said it was one of his top picks when he was on with you recently, Scott. The $100 billion company dominates at this point in South America, making up roughly half of online sales on the continent. That's according to eMarketer. Mercado Pagos is the other side of the company, really the payments provider there. CEO Marcos Galperin telling me despite all the volatility over the years, there's still a lot of growth to be found in LATAM.
When you look at the penetration of e-commerce in Latin America, it's still quite low compared to the US or Europe or Asia. When you look at the penetration of financial services in the region, roughly half of the population is unbanked or underbanked. So it's an enormous opportunity for us.
Amazon and Shein also have an eye on Mexico in particular, but Galperin does argue at this point they can still maintain a moat that they've been building since the company was founded in 1999. Scott, back to you.
Yeah, Kate, you mentioned Brad Gerstner. Let's listen, in fact, to what he said, because he said it out at the Goldman Sachs Communicopia and Tech Conference where we were both sitting where he appeared. Let's listen.
You look at companies like Mercadolibre or a company like Coupang in Korea, there are a lot of companies that people have kind of forgotten about as they moved in to the Mag 7, right? I think there are going to be a lot of internet companies that are benefited by AI. Like I said, not only margin expansion, but re-acceleration at the top, where they can acquire customers, improve their products, in a way that make it easier for customers to buy, take friction out of the system. I'm still excited.
Josh, have we forgotten about some of these? I mean, I know you like Amazon, you own it and love it and all that, but as Gerstner says, and as Kate perfectly lays out for us, this one's the outperformer.
Yeah, I missed this personally. I've been following it and I just never pulled the trigger. The stock got absolutely hammered after the pandemic, just like every other e-commerce or payments play. And that was the time if you had missed it all these years. And of course, I didn't pull the trigger. I was probably distracted by Handmaid's Tale or something. Now I'm not a buyer. This stock is now, in my opinion, is now fully discounting the very bright future this company probably has. But the next time it gets crushed, the next time they miss earnings or something, hopefully I see it, because I really do think that this is going to be a dominant internet company for the next 10 years in that region. I also think there's a bigger story, a renewed willingness on the part of U.S. investors to look overseas. When you look at the Argentinian stock market, for example, being up 70% over the last year, when you look at India being the best performing market in the world, like there are other options outside of the S&P 500, and this story is a great reminder of that.
Yeah, Kate, I mean, you look at the chart, it's really been a spring breakout, right? From the spring until now is where the bulk of this action has happened.
Yeah, it really aligns with the margin story. If you look at some of the margin expansion, it's actually quite similar to what happened with Amazon. They went through this massive investment cycle, margins went negative, and now they've expanded to double-digit margins again. So you've seen the stock chart kind of mirror that. And then they've also got this advertising business where there's a lot of optimism. Again, a parallel to Amazon, where that's part of the bull case here in the U.S. But you mentioned AI, and that's something Brad Gerstner talked about too. Marcos Galperin, the founder, said, we're using it, it's helping the cost basis. And so there are a lot of parallels when you look at sort of the tech thesis here, at least when it comes to Amazon and sort of the North American story, and what's going on with Mercadolibre. And they are expanding. They're the dominant player, and then they've also got the payment side. You have sort of this flywheel effect where that's the only payment provider you can use when you use Mercadolibre. So analysts I've been talking to say you get this kind of flywheel effect, and it is really a blue chip Latin American company.
Yeah, Kate, thank you. It's Kate Rooney, perfect setup for us on a stock that probably should get more of our attention. Calls of the day, one firm more than doubling its price target on a stock that both Josh and Brian are in. We're going to bring you the name later. Costco hit with a big downgrade ahead of earnings this week. We'll debate that call. We're back after this. All right, let's start with Starbucks. Thinking about Costco still. Starbucks downgraded to underperform from poll at Jefferies. Price target 76 from 80. They say the CEO is going to be challenged by issues like culture, value perception, and tech fixes. You own that stock.
Yeah, we initiated it with a decent position in our value portfolio on May 1, so it was around $75. So I still think that there's some room to play there. I think there's too many haters in the stock. And we need to give Brian some time to get the operations going in the right direction, which we think he will.
Okay. Uber reinstated strong buy. Ray J. Price target to 90 from 41. Wow, so this thing blew way past their target, Josh.
Yeah, they've been very incorrectly coy about the potential, and now they're waking up. I still think the stock goes to 100 at a minimum. It's 34 forward PE with 110% earnings per share growth expected next year. It is almost criminally misunderstood, probably because the folks who cover it don't cover the big tech platforms. It's like automotive analysts. This is going to be a massive platform. It's trading 10% above its 50-day, 10% above the 200-day. RSI is 64, so not overbought. Today, the stock's up 3%. It's 12th best performer in the S&P 500. I think the big picture that people are going to come around to is that Waymo is going to be a source of growth, not a competitor. Uber is going to be the demand aggregator in the automotive taxi space. Waymo will need Uber a lot more than Uber needs Waymo. Mark my words, that's what people are going to realize, and when they do, they're going to take this thing higher.
All right, Lowe's upgraded to outperform. That's at Oppenheimer. The target goes to 305 from 230. Mr. Belsky.
Now, this stock's trading at 5 multiple points below Home Depot. It's a dividend growth machine. We own it in our value and our dividend growth portfolios. I mean, this is a steady Eddie, great management. And I think it speaks to what we talked about earlier in terms of consumer discretionary. I think the opposite. These stocks do very, very well in that environment.
Is it time to buy Walmart like Truist suggests today? They raise it to buy from hold. They take the price target to 89.
We love Walmart, Costco, but Walmart, is one of our core positions. Is the time to continue to buy more. We'd hold it. I don't know if I'd continue to buy here, but we're definitely going to hold that stock through this.
What about Casey's General, Jim? Initiated by Melius Research today. $435 is the price target on this one.
It's a very well-run company, and I wouldn't be surprised if people didn't know what it is. It's a mid-cap stock. It runs a chain of convenience stores in the middle of America, gas station convenience stores. When I say it's very well managed, there's a couple of things here. They're doing great on expanding margins, and they're making key acquisitions to expand sensibly. Yes, 25 times forward earnings may look a little pricey, but when you get a good retailer, and think about a TJX, and yes, I'll even throw Costco out there, these multiples can be sustained. It's management, and that's what this company has.
What about AT&T, Belsky? Top pick at Goldman. And that's ahead of their earnings. Target goes up by a couple dollars to 25 from 23.
I think it's a great value name here, especially how the operating results recently. It's been a great performer year to date. A lot of people betting against it. And plus, going back to communication services, it affords the investor a great opportunity to barbell it. I mean, obviously, there's lots of love in Netflix and Google, but AT&T provides that barbell in that sector.
What about Schwab? Target gets cut by a few dollars, 77 from 80. Deutsche Bank, they still like it, but they talk about potential downside risk into their earnings report.
I think it's a great stock for a value portfolio. It's lots of momentum here as of date. I mean, we prefer Goldman and Morgan Stanley for the pure brokerage side of things. But from a value perspective, we think Schwab looks very, very good in terms of inflows coming in over the next 6 months.
All right. We're going to take a quick break. We come back. We've got a double play. On industrial names, 2 big committee stocks are on the move today. We'll break them down next. Let's do some committee stocks on the move. How are you thinking about Boeing? Best and final offer? The strike enters its second week. Do you think it's relevant to the stock movement at this point or no?
This is a stock that has disappointed us. We bought a little bit more, about 5 points higher a little while ago, just as a contrarian bet within our value portfolio. It's getting deeper value. The stock is desperately trying to bottom. I mean, I think from a longer term perspective, new leadership and all that's going to bode very well. But this is just another, let's call it a hiccup that is not really working in the stock's favor.
Okay. Let's talk tractors, Jim's favorite topic for obvious reasons. Former President Trump threatening 200% tariffs on Deere. You own Deere, not a Deere, but you own Deere.
I know. You know how to get me on this. What tariffs are you
going to?
gonna...
the facts.
Okay.
State of the farmer Jim. We talk tractors.
Okay.
Kind of like a no-brainer.
All right. Well, look. So here's the thing about Deere. Let's put aside the tariffs just for a second. The stock is up nicely over the last few months, and clearly that is the stock market anticipating, as the stock market does, that crop prices have bottomed, that farmer profits are going to pick up, and that Deere's earnings have hit trough. I think that's a reasonable, if not certain, it's reasonable to assume that. At the multiple that we've got on Deere, I'm comfortable owning it for now. The tariffs thing with President Trump, ex-President Trump, maybe he'll be president again. It sounds like one of those things where he shoots from the hip. He's known from doing it. Look, I'm not sure that that there's an unemployment problem in the U.S., and if it is, let's take those Deere workers who might be laid off if production goes to Mexico and ship them to Arizona to man the Taiwan semi plants that are being built there. This isn't... To the extent there's an unemployment problem, it's not Deere's fault.
All right, let's go to Phil LeBeau. He has the news alert for us. Hi, Phil.
Hey, Scott, Elliott Management out with a new note to shareholders of Southwest Airlines saying that they do intend to call for a special shareholder meeting potentially as soon as next week. Remember, Elliott has threatened to call for a shareholder meeting as they believe that the current management and the current actions by Southwest Airlines are not enough to improve the position of the airline right now. So as a result, they are telling shareholders that they plan to call for a special shareholder meeting. They are also telling shareholders, particularly those who may have lent their shares through their broker, to make sure that they are in a position to vote by as soon as October 7th. This is not a surprise, Scott. We've known for some time, and we've talked with people familiar with where Elliott is, that they're not happy with where Southwest is, with the current leadership. And we know that there is an investor day on Thursday where Southwest will provide greater detail for how it plans to turn around the airline. I don't think that matters to Elliott. Elliott's belief is there's nothing you can tell us right now that convinces us that this is the right path for the airline, and therefore they are notifying shareholders that they do plan to call for a special shareholder meeting, perhaps as soon as next week. And remember, there are 10 people who Elliott believes should be added to the Southwest Board of Directors. We'll see what happens not only Thursday at Southwest, but over the next couple of weeks. Scott, thank you.
It's gonna get spicy. Phil, thanks. Phil LeBeau with the latest there. Still ahead, we've mentioned Costco. Now we're going to give you the trades ahead of its earnings later this week. The setup, and Belsky is next. Let's do the setup, Belsky, okay? Thursday, after the bell, Costco got downgraded today to hold from buy at Truist. Price target's at 873. Stock's at 905.5. Also initiated hold today at Melius, 950. Street's a little, ho-hum on it right now. What about you?
I don't know how you can actually ever even think meh about Costco.
Well, stock's had a great run. I mean,
Yeah.
so that's why they're hold.
No, I know, I
on
get
it
that.
here.
I get that. But if you had 25 stocks, you could only buy 25. This is one of the best 25 stocks in the world. I know you love when I say this, period. 12 and a half years ago when I came to BMO, it was one of the very first stocks I bought in the large cap money up there. If you look at a book and you say a model on how to run a retailer,
Yeah.
it's Costco. It's a great company. Talk about, capacity versus scarcity. They do a great job about not adding too many stores. They got the online presence. They got the inventory control. They got all the other great things that they do over there in terms of their modeling for their inventory. It's a fantastic company.
In the 30 plus years you've been doing
I
this,
didn't-
it's one of the best names you've ever seen.
Yes, I would say that. Thank you.
Had to. Shan, you have thoughts?
Yeah, I mean, I think there's an intersection here where this discerning consumer is really looking for value, but they're also looking for convenience. And that's why you see the dollar stores, the fixed price stores, they're continuing to struggle despite the fact that wallets are squeezed. And so Costco gives you both of those things in one location and appeals to a very, very broad demographic.
I mean, I said it so you didn't have to.
I know.
It saved you.
Thank
You
you.
should be thanking me.
Wonderful.
All right, we're back after this. We'll highlight a couple of winners and losers for you as we like to do. Take a look at the winners. Las Vegas Sands, FMC Corp. Keep your eyes on both of those stocks today, which have been winners on the session and still are. There's Sands up almost 6%. Losers is where we really wanted to focus, though, because Regeneron was downgraded today at Leerink. You own that, and that's been a mover today by about 6%. What do you think?
Money's been coming out of healthcare here for the last couple of weeks, though. I think part of it is with the other big drugs, but Regeneron's our position relative to our barbell with Gilead. We still like the growth in that stock, but we're going to stick with it.
Palantir was the other one on our list. We just noted it because it did touch an all-time high before selling off a bit, about 3.5%, which you own as well. But again, I mean, there's nothing to be unhappy about with the run that this thing's been on.
No, it's an incredible company. We doubled our position a couple months ago. This is one of those names in tech where we want to trade down from the Mag 7 into these types of names.
Yeah, it's a 4-month win streak. We'll come back with finals next. What's your final?
PayPal continues to make new highs. I am rolling up my stop loss, but staying with the trade.
Thank you very much, Brian Belsky.
Citizens Financial, 4% dividend yield. It's a dividend grower, 18% free cash flow yield.
All right, good having you back with us here on the desk. Farmer Jim.
Cisco Systems, I continue to believe this quietly, softly is going to set a new high for the year.
Thank the guy. Why are you laughing? Expecting, like, was it code for something else you thought maybe?
Thanks a lot for having us.
That's our pleasure. Dude, if you have more than 30 years experience, you're welcome anytime on this program, okay? Shan, what's your final?
Rates, it's not just declining inflation and lower rates, it's also that they're in good shape. They have termed out their debt during the low rate period.
All right, good stuff. I'll see you on closing bell. See what this market does over that last hour in the exchanges now.